The situation between the United States and Iran just changed. And while every financial news channel is covering the geopolitical angle, while every defense analyst is discussing military posture, and while every macroeconomist is talking about oil prices and safe haven flows, there is a dimension of this story that nobody in the XRP community has fully assembled yet. A dimension that connects what is happening between Washington and Tran directly to XRP, directly to the institutions that have been building positions in the background, and directly to a repricing catalyst that geopolitical crises of this magnitude have historically accelerated rather than delayed. Tonight, I'm going to break down the connection between the US-Iran situation and XRP specifically. Why geopolitical conflict between the United States and a sanctioned nation-state is a structural accelerant for the technology Ripple built. The institutions that have been watching XRP from the sidelines now have a geopolitical argument on top of their commercial argument for moving in. How the US government's relationship with XRP becomes more strategically important, not less, when international tension escalates, and what the price targets look like when a geopolitical catalyst layers on top of an institutional setup that was already loaded. Every number you're about to hear comes from publicly available government communications, institutional research, geopolitical analysis, and on-chain data. Before I continue, this is not financial advice. I'm sharing publicly available information for educational purposes only. Always do your own research and consult a qualified financial professional before making any investment decisions. Let me start with the geopolitical reality, because understanding the connection to XRP requires understanding what the US-Iran situation actually represents at the level of financial infrastructure rather than military posture. The United States and Iran have been in a state of financial warfare for decades, long before any military escalation becomes a headline. The real battle between Washington and throne has been fought through sanctions, through payment system exclusions, through correspondent banking restrictions, and through the control of international financial infrastructure. Iran has been excluded from the SWIFT network, the Belgian-controlled international payment messaging system that processes the majority of global cross-border transactions since 2012. That exclusion was the most powerful non-military weapon the United States has deployed against Iran. It cut Iran off from the dollar-denominated global financial system more effectively than any military embargo could have. But here is what that decade-long financial warfare has revealed about the current global payment infrastructure that almost nobody is discussing in the context of XRP. The SWIFT-based correspondent banking system that the United States used as a financial weapon against Iran has also been the system that America's allies and adversaries alike have been quietly building alternatives to. China's CIS system, Russia's SPFS network, the digital yuan's cross-border payment infrastructure. These are not being built because China and Russia want more efficient payment systems. They are being built because the US-Iran situation demonstrated to every nation-state on Earth that dependence on the SWIFT network means dependence on American financial policy decisions, and the nations that have decided that dependence is unacceptable have been building alternatives for a decade. This is where XRP enters the geopolitical story, and this is the connection that the mainstream coverage of the US-Iran situation is completely missing. Ripple's technology was built to solve the same problem that SWIFT solves, but without the centralized control that makes SWIFT a geopolitical weapon. The XRP ledger operates without a central authority that any single government can pressure to exclude a participant. It settles transactions in 3 to 5 seconds, regardless of the political relationship between the sender and the receiver. It requires no pre-funded Nostro accounts that correspondent banks can freeze under regulatory pressure. And it operates across every currency corridor simultaneously without requiring the bilateral banking relationships that make SWIFT-based payment corridors politically controllable. From the United States government's perspective, this creates a strategic calculation that the US-Iran situation makes more urgent. If American allies and neutral nations continue building alternatives to SWIFT because they fear US-controlled payment infrastructure, the dollar's role in global trade diminishes. Every transaction that moves through CIPs or SPFS instead of SWIFT is a transaction that does not require dollars. The long-term threat to dollar dominance is not Iran's military capability. It is the gradual fragmentation of the global payment system into dollar and non-dollar rails that the US sanction toolkit accelerated by demonstrating that SWIFT access can be revoked. Ripple's technology operating under American regulatory frameworks, providing the efficiency and finality that SWIFT cannot match, but without the centralized control that makes SWIFT a geopolitical liability, is the American answer to that fragmentation risk. A global settlement layer built on American technology, regulated by American authorities, and operated under American legal frameworks is a dollar dominance tool. It gives every nation that wants efficient cross-border settlement an American alternative to CIPS and SPFS that does not require surrendering payment sovereignty. The US-Iran situation makes the urgency of having that alternative more visible to the policymakers who control the regulatory environment that XRP operates in. When geopolitical tension between the United commercial thesis, a geopolitical thesis, and the geopolitical thesis for institutions is different from the retail speculation thesis in a specific and important way. When geopolitical tension escalates, institutional capital does not flee from infrastructure. It concentrates in infrastructure. The assets that benefit from geopolitical instability are not the speculative ones. They are the ones that solve the problems that geopolitical instability creates. Gold is the classic example. When nations go to war or come close to it, gold performs not because of speculative demand, but because gold solves the store of value problem that conflict creates for every currency in the affected region. XRP's geopolitical performance thesis is analogous but more specific. When nations threaten the integrity of the SWIFT-based payment system through military action, sanctions, or retaliatory financial measures, the assets that provide payment settlement independent of that system becomes strategically valuable in a way that commercial analysis alone does not capture. The institutions that were at 80% conviction on XRP based on the commercial thesis alone are now looking at the geopolitical dimension and recalculating. The US-Iran situation is a live demonstration of exactly the problem that Ripple's technology was built to solve. It is a real-time proof of concept for every argument that Ripple's sales team has been making to bank treasury departments and institutional allocators for 5 years. And when a technology's value proposition is being demonstrated in real time at the geopolitical level, the due diligence cycles at institutional allocators compress. The urgency increases. The conviction threshold is reached faster. Now, let me walk through how specific institutions are responding to this geopolitical context. Layering on top of their existing commercial positioning, Goldman Sachs's $154 million disclosed position is a backward-looking filing. What Goldman's geopolitical risk desk is modeling right now in the context of escalating US tension is the scenario where the fragmentation of the global payment system accelerates beyond what the commercial adoption curve had assumed. Goldman's proprietary geopolitical risk analysis, which feeds directly into their trading desks and asset management divisions, would be modeling XRP's value in a scenario where dollar payment infrastructure becomes both more contested globally and more urgently needed by the US government. That modeling produces a higher probability weighted price target than the commercial thesis alone. And a higher probability weighted price target from Goldman's models means a larger position, not a smaller one. Bank of America's Ripple pattern portfolio represents years of documented institutional conviction. But pattern portfolios are commercial instruments. They protect competitive advantage in technology that generates commercial returns. The geopolitical dimension of the US-Iran situation adds a national security justification to Bank of America's existing commercial justification for XRP deployment. Large American banks have historically moved faster on technology adoption when national security considerations align with commercial incentives. The government does not need to tell Bank of America to deploy Ripple's technology. The geopolitical context makes the internal business case for deployment more urgent on a timeline that bank leadership's own strategic planning teams are recalculating right now. JP Morgan's Onyx platform and its architectural compatibility with the XRP ledger becomes more strategically significant in a geopolitical context where the integrity of international payment infrastructure is visibly contested. JP Morgan processes more international wire transfers than any other US bank. Their corporate clients, the multinational companies that manage global supply chains across the Middle East and other regions affected by the US-Iran situation, are experiencing payment friction in real time as correspondent banking relationships adjust to the geopolitical environment. The efficiency case for switching those payment flows to Ripple's on-demand liquidity solution is being made right now, not by Ripple's sales team, but by JP Morgan's own clients, whose payment delays and increased costs are a direct consequence of the geopolitical situation. BlackRock's approach to the $3 billion AUM threshold that triggers the XRP ETF entry is accelerated by the geopolitical context in a specific way. BlackRock manages sovereign wealth fund money from multiple nations, whose own payment infrastructure interests are affected by the US-Iran situation. The sovereign wealth funds of allied nations watching the US-Iran escalation are recalculating their own exposure to SWIFT-dependent payment infrastructure. When BlackRock sovereign wealth fund clients are evaluating infrastructure diversification, BlackRock's ability to offer XRP exposure through a regulated ETF becomes a product solution to a client problem that the geopolitical situation has made more urgent. That client urgency compresses BlackRock's AK's internal timeline from monitoring to filing. Now, let me explain the US government dimension because the geopolitical situation changes the government's relationship with XRP in ways that are commercially significant for every institution that holds or is evaluating XRP. The US government's digital asset policy framework has been Let me give you the supply dynamics. Because the geopolitical and institutional story hits a supply structure that makes the price impact more acute than either the commercial thesis or the geopolitical thesis alone would suggest. XRP has a circulating supply of 61.3 billion tokens, but the effective free float available for institutional purchase is dramatically smaller. Ripple holds 34% in escrow. Long-term whale wallets hold approximately 17% with multi-year holding periods. Approximately 60% of current holders are at unrealized losses with cost bases above current prices, making them dormant supply until meaningful price recovery occurs. The free float is small, and the geopolitical situation is adding a demand dimension that was not in the institutional modeling 3 months ago. Institutions that were calculating their XRP position size based on the commercial thesis alone are now modeling a geopolitical premium. Sovereign wealth funds that were evaluating XRP as a commercial infrastructure play are now evaluating it as a payment system diversification tool. Government agencies that were assessing Ripple's technology on a commercial procurement timeline are now assessing it on a national security timeline. Each of these demand increments is hitting the same constrained free float. The supply structure does not change because the geopolitical situation has escalated. The demand structure does. And when demand increases against a supply that cannot expand at the same rate, the price adjusts. Now let me give you the investment calculator because the geopolitical premium needs to be translated into numbers. At 100-day free to Hazi, $1,000 buys you approximately 704 XRP. At $2.80, Standard Chartered's near-term commercial thesis target. Those 704 tokens are worth 1,771. At $5, the lower bound of the repricing range that the geopolitical catalyst layers on top of the commercial thesis, they are worth 3,521. At $8, the upper bound of the near-term geopolitical catalyst scenario, they are worth 5,630 tools. At $12, The intermediate target that assumes the institutional ratio flip completes on an accelerated timeline due to combined commercial and geopolitical urgency. They are worth 8th Zypher Faint Team 48. At $20, the velocity model output for the scenario where US government national security adoption combines with institutional commercial deployment in the same quarter. They are worth 14,785. At $28, Standard Chartered's 2027 target, they are worth 19,718. At $50, the macro framework output for a scenario where the global payment system fragmentation that the US-Iran situation accelerates drives meaningful adoption of American-built alternative infrastructure. They are worth $35,000 and $200. At $5,000 invested, multiply every number by 5. At 10,000, multiply by 10. At 25,000, multiply by 25. The structural Florida $27, defended by over $400 million in on-chain cost basis accumulation, puts the maximum downside from current prices at approximately 10%. The upside to the near-term institutional and geopolitical catalyst target range is 200 to 3,400%. Geopolitical situations have historically been the catalyst that compress the timeline between institutional positioning and institutional repricing. The commercial thesis was already loaded. The geopolitical catalyst is the accelerant. Now let me lay out the catalyst sequence that the US-Iran situation sits at the beginning of, because sequencing is everything when a geopolitical trigger lands on top of an institutional setup. The immediate institutional response to the US-Iran situation is the recalculation happening right now in the risk management departments. The geopolitical analysis teams and the asset allocation committees of every major financial institution that has been monitoring XRP. Goldman's geopolitical risk desk, Bank of America's strategic planning team, JP Morgan's treasury division, BlackRock CK's